Hi, this is Antwone Harris with Platinum Bridge Wealth Strategies, and I wanted to start by taking a look back at 2018. If you look to the right of your screen, this shows every asset class in the world, starting with cash, through fixed income or bonds, all the way through real estate, large company US stocks, international stocks, and emerging market international stocks. Cash was up 1.8%, bonds had a 0% return. Every other asset class was down between -4% and -14%. Now that's an aberration. We typically do not see all of these different asset classes around the world going down simultaneously. The last time we saw that was back in 2008. And even that year, bonds were up 5%. So a couple of things. The situation in 2008 is much different than what we're seeing now. At that point, we had a real estate crisis that spread across the world. The banking system was in jeopardy. We have nothing like this happening at this point. The main things to focus on are one, the Federal Reserve, two, global economic growth, and three, the relationship between the US and China regarding the trade situation. So let's start here. This line represents the S&P 500, and this is the bull market that started 10 years ago. This line here, this is the longest bull market in history. So the dip that we've experienced recently is represented right here. And it's almost a blip on a radar screen when you're taking a look at this in context of a very long, very sustained bull market. Now, it's very uncomfortable when we go through it, but the good news is this shows the valuation of the market from for the PE ratio for the S&P 500. Right now, we're trading at about a 10% discount to the long-term average, which is represented by this dotted line. So we're here. So the market is on sale. We're trading, again, at about a 10% discount. So that bodes well for the market. Typically, if you see a bubble, you see a situation like this where the price to earnings ratio was all the way up here and the market is trading at a very, very high multiple. It's very expensive and people are overpaying for stocks. And that's when you have this precipitous drop in the market. But we're not in a situation like that. There's probably about a 25 to 30% chance of us going into a recession. Now, typically, a bear market is accompanied by a recession. So the last 10 bear markets, 8 of those were associated with a recession. So if we're concerned about a bear market, then we need to think about the likelihood of us entering into a recession. Now with regard to the U.S. economy, 70% of our economy is based upon the activities of our consumers versus businesses. So if the consumer is strong, then typically that bodes well for our economy. So we're at 50-year lows with regard to unemployment. Wages are growing over 3%. Inflation's been contained. So the consumer is actually in a pretty good spot. Now, as we look forward, we're expecting our growth to slow economically, but we're still expecting growth. So we're expecting about a 2% growth to our economy next year. We're expecting about 1 to 1.5% growth around the world. So the economy is not expected to contract at this point, which would represent a recession. We're expected to continue to grow, albeit at a slower pace. The third thing to focus on is the relationship between the US and China. And this spans well beyond any tariff situation. This is actually a vie for global economic supremacy. So back in 2006, the United States economy represented over 27% of the world economy. China was at 5%. Well, in the span of 11 years, China has closed the gap. They now represent 15% of the world economy, and we're down to 24%. So we're the largest economy in the world, and China is now number 2. But China is growing 3 times the rate of the U.S. So it's very likely that in the next several years, China may overtake the U.S. as the leading economy in the world. That's the challenge. That's the issue. And that's not going to be resolved here in the short term. So as we look out through 2019 and beyond, we have better valuations. The Federal Reserve has indicated that they're going to be a bit more accommodative and a bit more responsive to what's happening in the market, which was different than what they said before. We continue to have economic growth, albeit at a slower pace than we saw in 2017, 2018. Now, the wild card is China-U.S. relations. Again, that's not going to be resolved quickly. But if we have any kind of short-term truths associated with that, that should bode well for the markets. And this happens to be one of my favorite slides. This looks at stocks, bonds, and a 50-50 stock bond portfolio going back to 1950. And it looks at every rolling 1 year, every rolling 5-year, 10-year, and 20-year period. Now, the worst year for stocks was down 39% since 1950. This was 2008. And then the worst year in that same year was down 15% for a balanced portfolio. But what's informative is that there's never been a negative 5-year period for a 50-50 balanced portfolio of stocks and bonds since 1950. So the most important decision that you can make is to have the right asset allocation in place, and then start to take a step back from the noise that we saw in 2018, any uncertainty in 2019, and start to take a look at the bigger picture. And as long as that allocation is in place and we continue to monitor things and rebalance, over time, we're going to be fine. If you have any questions, please let me know. This is Antwone Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.